what's likely is that if interest rates are actually going up because of the fact that our houses are really not worth $500,000 because most people aren't paying cash, the house is worth what the monthly cost of the average mortgage is at a $500,000 house. So typically what's going to happen is if interest rates go up, housing prices are not going to go up in value with the interest rates. They're typically going to come down. So when we get into times of challenge, into hardship and economic turmoil in our country, your HELOC, and this is at any time actually, it just happens to be, it's most likely to be frozen during times of hardship, but your banking institution or the lender can freeze your HELOC at any time. Hey, what's going on, cash flow hackers? It's Chris with Life 180, and for this video, I want to talk to you about cash out refinances versus home equity lines of credit. And now there's a lot of debate, there's a lot of questions I get from people about which is best, and so for this video, we're going to get into exactly that. So to start, let me talk about cash out refis. What is a cash out refinance? So a cash out refinance is ultimately when you get a new mortgage completely. So what you do is, as the values of your home have gone up in the market, as you've done mortgage pay down through just making your payment every month, the combination of those two things, ultimately what you do is you build equity into your home. And so maybe you started with a 30-year mortgage, maybe you have been paying on it for 5 years, the equity's gone up, you paid the mortgage down a little bit, and so what you do is, instead of having 25 years left and having all your equity tied up in the capital of your house, what you do is you get a new mortgage and you're allowed to cash out the equity in your home as long as you leave, based on an appraisal, about 20% equity in your home. So for a lot of people, especially in today's market, that is a huge opportunity to access and control the capital that you have in your house. So what's a HELOC? Well, a HELOC is a home equity line of credit. And what that is, it's ultimately like a revolving line of credit, kind of like a credit card. Like a cash out refi, it's going to be based on your credit worthiness and the amount of equity that you actually have in your home. Very similarly, that would be to a cash out refi. So what I think would be beneficial now is talk about the positives of each, and then what I'll do is I'll get into the negatives of each, right? So the positives of a cash out refi, to start, is you can change your terms for a better interest rate, for better overall terms. If you follow my content, you know I'm a big believer you should never keep your capital locked up in your home, right? So here's the deal. When I say that, I'm talking about in today's environment, right? We live in this reducing interest rate environment. So in today's low interest rate environment, I'm a huge fan of financing for as long as we can, for as much as we can. So what that would mean is any equity that we have in our home above the 20% is inefficient, and we're taking on unnecessary risk. So I would want to finance that for as little amount of money as possible, like in the 3%-ish range right now. I would want to do that for 30 years. So if I've got a 25-year mortgage, I could cash out refi all the equity that I have, and then I could extend my mortgage back from 25 years to 30 years. And if you want to know more about why I suggest that, I'll actually put a link to how to pay off your house up in the corner here, and you'll see exactly what I'm talking about on why I feel that way. But the other great part about this, if you think about it, is as interest rates continue to go down, it just makes sense from an efficiency perspective. If you have a 4.5% mortgage, refi to 4. If you have a 4% mortgage and you can refi to 3.5, it just makes sense over the long term. Now, you do got to be careful about closing costs, but I'll get more into that later. The bottom line is, I've seen people take cash out and reduce their interest rate payments to make it so they gained control of the capital in their home, the equity in their home. And guess what? When they do that, their mortgage payment didn't even go up every month. It's pretty amazing. So I would say the second benefit of this, I actually talked about, alluded to a little bit in the first comment, I suppose. But ultimately, this is, you shift the market risk from you to the bank, right? Because if you have a lot of equity in your home, what you're doing is you have that market risk, right? Like this happened in 2008 a lot. When you have a lot of equity in your home, if the market plummets, that risk is on you, that your equity, your net worth goes down. But if you take the cash out and you put that cash somewhere safe, even if you go negative equity in your home, you have a pile of cash, if you handle it properly, that you can leverage during times of challenge in the economy. And that can be an amazing opportunity fund to help catapult your wealth forward. Now, the third benefit for a cash out refi is a simple one. It's just the fact that it can be easier to budget because it's a single monthly payment. It's typically fixed. It's typically structured because you're doing a 30-year or a 15-year fixed mortgage. As you could tell, if you watched the How to Pay for Your Mortgage, I would go a 30-year every single time. I've got a lot of reasons why. You need to watch that video if you haven't. But ultimately, human nature is it's easier to budget, and when we have consistent payments and we know what those payments are going to be, it's easier for us to execute on what we know and what we are planning for. Whereas home equity lines of credits, comparatively speaking, tend to be more variable, uncertain, and we just have to manage it more regularly. All right, so now let's get into the positives of a home equity line of credit, the HELOC. So the first positive of a HELOC is the fact that you have access to a line of credit, and access to the money is available when you need it. So you only pay interest when you actually use that money, right? So if you did a cash out refi, you're taking this chunk and that interest you're paying for all the way. Now you control the money, but with a HELOC, you get this access to a line of credit, kind of like a credit card line, right? But you only pay the interest for the money that you use, right? So that's a benefit. Now the second benefit is that you typically have lower closing costs than a cash out refinance. Home equity line of credit closing costs are typically far lower, significantly lower than a cash out refinance. So what are the negatives of a cash out refinance? I talked about the positives earlier. I want to be equal and equitable across both boards here. The negatives of the cash out refinance, like I just talked about, the closing costs are higher. We have to take that into consideration, depending on how much money you're saving, how much cash you're getting out of the house, how much equity you're regaining control of. You have to weigh whether that makes sense to you or not. Now, the other negative potentially to a cash out refi is that in an increasing interest rate environment, cash out refis might not make as much sense due to the fact that if you have a low interest rate on your mortgage right now, those costs could go up, right? So that could actually increase your chance. So it becomes a harder thing to weigh. Is it worth paying more interest on my entire loan to gain access to this capital, right? We have to take all that into the equation. Now, I don't know. What I will say is, even though that's the case, what's likely is that if interest rates are actually going up because of the fact that our houses are really not worth $500,000 because most people aren't paying cash, the house is worth what the monthly cost of the average mortgage is at a $500,000 house. So typically what's going to happen is if interest rates go up, housing prices are not going to go up in value with the interest rates. They're typically going to come down. So it's actually increasing interest rates and increasing interest rate environments that kind of encourage me that right now, I think we're going to head into an increasing interest rate environment, right? So I'm saying refinance at the lowest rate you can possibly lock in right now for as long as possible, because it's going to benefit you over the next 30 years, right? And it's going to give you control of the equity of your house. So when interest rates go up, if you do lose that equity, you have a pile of money sitting on for opportunity to take advantage of when the times are rough for the rest of the world. Because if the real estate comes down and you have a pile of money, that money's going to go a lot further for you. So I would say the third negative of a cash out refi is simply risk, right? If you cash out refi and you take up to 80% of the equity, whatever available cash equity in your home is there, up to making sure you keep 20%. If interest rates do go up, or for some reason the equity, the value, the appraised value in your house goes down and you have less than 20% equity in your home, the lender could charge you a private mortgage insurance fee, a PMI fee, right? So that could increase your cost. So you could incur a charge monthly until you regain that 20% equity. So you just got to look at the terms and make sure that you're not exposed to that, or if you are, that the potential risk is worth it for you, like anything else. All right, so those are the negatives, the main negatives of a cash out refi. So let's talk about the negatives of a home equity line of credit. So like I said before, ironically, interest rates are variable, and a lot of people would look at that in today's interest rate environment and be like, well, that's a nice thing. But because they're variable and they're not fixed, and what we're talking about right now, the chairman of the Fed, Powell, is talking about the fact that next year they could have up to 4 rate raises, right? What does that mean? That means your variable rate is going to potentially go up, and I think there's significant risk that the rates will go up. So more than likely, your carrying costs for those loans are going to go up. right? Like, so that's just something to take into consideration. Now, the second thing, and this is the big one, right? This is the really big one. Like I said, I'm a big believer that we need to own the equity in our home. We need to control that equity in our home at all times. So when we get into times of challenge, into hardship and economic turmoil in our country, your HELOC, and this is at any time actually, it just happens to be, it's most likely to be frozen during times of hardship, but your banking institution or the lender can freeze your HELOC at any time. Now, this happened during 2008, and it even happened at the beginning of COVID. Banks were freezing or canceling inactive HELOCs. Now, if you have a loan out, they can't call that loan due immediately. They got to allow you to make your payments, but they can freeze it so you can't use it for any more purchases. So that's key to understand. So this is one of the big challenges, because with a HELOC, you're never really in control of your equity or in the capital, right, that you have in the HELOC, because if they can shut it down on you when you probably need it most, then to me, you're still taking on all that risk, right? Like the bank is they're in control of your financial situation and the equity in your home. And ultimately, the whole purpose, if I'm thinking about why I either am considering a HELOC or a cash out refi, it's really about control, right? So if you're planning on using the money of this, to have good, stable control, and there's a couple rules that I would say. If you use that money, don't use it on something super risky, right? Because if you take a loan from a HELOC or you do a cash out refi and you use that money and you put it into something risky, an investment, and you lose it, you're going to have to pay that money back anyway, right? And so you don't want to, increase, your fees and everything, the charges and expenses that you have with either of these options over time by putting it into something risky. So I'm a big believer you want to keep it somewhere safe. And if you want to use it for an opportunity fund, what I would say is, you want to make sure you control it. So when I think of the two, all things being equal, yes, the closing costs for a cash out refi are a little higher. But when I think about control and the importance of really truly controlling the equity in my home, if you're going to be disciplined with that money and you have a plan with that money, I would say that for me, most of the time in today's environment, listen, 3 years from now, this could be a different answer. And if it is a different answer, I will make a new video. But right now, I think most of the time a cash out refi at up to 20%, and I would refinance for 30 years as long as I possibly could. Once again, watch my video on how to pay your mortgage. I'll put it on the end screen as well. That is the direction that I would go. So if you found value in this, please hit that subscribe button, click that bell. That way you get notified every time I launch a new video. We got a lot of personal finance education videos coming out. If you have any questions, any comments, leave them in the comment section below. I do my best to engage with every single comment. Until next video, have a blessed, inspirational day, and we'll talk soon. See ya.